that people are, what the Fed's got going on and how they're managing things. We have the debt ceiling fight coming up. You have the war going on. You have, we're now out of the pandemic officially, I read, and yet we still have the further conflict with China and probably the Middle East. And we're seeing the banking crisis still playing out in the US, although it seems to be slowing down in terms of its problem, but it could rear its ugly head again. And then we haven't even gotten into the issues with commercial real estate. So it's easy to see the negativity that's out there, but I think everyone's leaning too far to one side of the boat. And I'm actually more positive on the outlook for the rest of the year. I don't think the dire warnings of a hard landing are have as high a probability as people think, as long as the banking system has been somewhat under control and politicians only do the limit of stupidity that they typically do with debt ceiling fights, which is take it to the 11th hour and then create a suboptimal deal. But I think with all the negativity out there, I think there are a number of things, areas in the economy that are quite positive. I think the reindustrialization that's going on, while it comes with some negatives, is actually one of the positives, particularly for areas like Ohio and certainly parts of the South. Canada and Mexico as well should be beneficiaries of it, and parts of Southeast Asia. I think the people that get hit the hardest will be a lot of the Chinese businesses and part of the European businesses, particularly some of the manufacturing bases that are high energy users in Germany and other areas where we've gotten the benefit of a warmer winter this year, but we're not out of the woods yet. So I think that's part of the problem. But I'm pretty optimistic about where you can make money in this environment and how things will play out for the rest of the year, barring the fact that we have arrested a lot of the big problems in the financial system, which I think we have. But getting back to the reindustrialization, for 75 years, the supply chains are built on really the lowest cost possible direct manufacturing costs. And we've switched now because of the pandemic, because of the war in Ukraine, because of other issues, really looking for safe, secure, and reliable supply chains, and the dependability that you need for that has really shifted the way countries and governments are looking at the whole supply chain system, and also how businesses are. And then you add to that the climate change issues and other issues that we're facing and some of the social challenges, and you really have, pretty potent witch's brew of things that could go wrong. But I think there are a number of things that are switching quite positively. Just by way of a little background, from 1970 to 2019, the US lost about 6.7 million jobs in manufacturing, which is about 34% of the manufacturing unemployment base. In recent years, that's been coming back, but as a result of that period where we were outsourcing to the lowest cost, China stepped up and filled the void, as we know, with their low cost advantage and with their very supportive subsidization of their businesses to keep the wages down. And obviously they have labor issues that we don't necessarily have here that they can deal with. But as a result of that, China now is responsible for 42% of the US penicillin imports, about 76% of global battery manufacturing, 76% of permanent magnets, which are used for the EVs, and 78% of the US rare earth compounds are coming out of China right now. So obviously the US government had a lot of concerns starting with the Trump administration and then going through the Biden administration. You add to that with going on in the war in Europe and with the tensions with China and Taiwan, and the world's at an inflection point. I think that we're going to see this inflection point be one of those things when you add in AI to it, as we were just talking about, and the advances there, that we're at a point where the global economy and the world are going to change permanently, and we're going to have to make adjustments to that. I think Ohio and Midwest states in the South stand to benefit from all these changes, but we're in a very different mode right now than we have been for some time. So I'm going to go through these slides pretty quickly, but I think there's three seismic shifts that are reshaping the global economy right now, and they've been going on for a bit of time. The geopolitical fragmentation, which is really China looking to usurp the US position as the dominant leading economy around the world. taking advantage of the policy mistakes and foreign policy mistakes in particular that the U.S. and the West have made in so many different countries around the world, where we go in to help them and leave them worse than we went in. China stepped up with an alternative vision of what a lot of these countries could become with an autocratic government and a command and control economy. And looking at the economic miracle that China's put forward with their support, is that a more appealing model than the model that the U.S. and the West has put out? And for many, that's resonating right now. And that shift is creating this new realignment that we've talked about of democratic versus autocratic nations aligning with another group that I think is going to be the best of the rest, looking to how they can play both sides against the middle. And you're seeing that with Saudi Arabia and other countries in the Middle East. Pakistan's in one of those dilemmas right now. Do they just shift more towards China, or do they keep the balance and play both sides against the middle? India's in the same mode. But as you switch from a free market system to one that's much more nationalistic, that's going to create higher cost of living, higher cost of supply chains, more defense spending, more areas that are going to have hoarding going on for key resources, and creating a different realignment of the political and economic map. But I think the second phase is we're going to have to adjust to rising living costs after a period of artificially suppressed inflation. And we've had that for such a long time that we don't think it's artificial. We've gotten so accustomed to it since the tech bubble burst, when we started bringing rates down and have kept them at near zero for most of the last 20 years. That's a very difficult period to adjust, particularly with the speed of the rate increase. On the positive side, this cost of living is moving back to what was really something we've lived with traditionally. And once we get past this rough adjustment period, we're getting back to not an outrageously high level of inflation. We're just having to deal with the shock of the sticker shock of it. We'll get used to it, we'll make adjustments and move on. But it does mean that there's stretching for demand for solving the needs of people, and that pushes governments to more short-term thinking. We have long-term problems that need long-term solutions, not short-term ones. But all this is leading to this reindustrialization of the global economy, pushing for bringing jobs back home, making your country more secure from a food, energy, infrastructure, and also cyber basis, as well as just border defense. Those are all things that are shifting, and we're in an economic and a political war right now that is going to play out. These things will be with us for some time. It really is going to be up to see how the U.S. and China determine how they're going to be both adversaries and competitors going forward. I believe will be the determining factor for where we go. But in the meantime, businesses are adjusting to these changes, and you're going to see it in the numbers about how we are reindustrializing. So since 2010, 1.6 million jobs have come back to the U.S. through reshoring and foreign direct investment. You can see last year we had almost 365,000 jobs come home, 3.5 times what it was in 2019. So we are moving back to a significantly higher level, and that hasn't slowed much. And when you think about the impact of this, manufacturing jobs have job multipliers, or the effect of adding other jobs for each manufacturing job, anywhere from 3.7 to some estimates as high as 11 multiple on that. To give you a sense, utilities are probably around the highest at about 15. We have a big utility upgrade that we're going to have to go through. And infotech has a significant halo as well, with almost 12 jobs for every infotech job that comes back. So this is a big thing for us, and it's going to reverse the trend that started with China's economic rise. And you can see as China's started to do so well, their wages came up and started to lose some of their competitive advantage. That gave opportunities for other Southeast Asian companies like Laos, Cambodia, Thailand to step in to become the low-cost producers, but they don't have the same wherewithal that China had, given their size, their heft, and their government support. So I think it's a very different construct. So this is a big opportunity for U.S. companies to do better, and for U.S. cities to do better as well in states. So you can see the foreign direct investment continuing to be strong, but really the reshoring of companies bringing business back to the U.S. is a bigger trend. And I think we're going to see that continue to accelerate, in part because to get some of the incentives that the governments are putting out, you have to be reshored and show a certain amount of content coming from the U.S. and that's being accelerated. So I think that's going to move companies to act faster. The other part of it is the blowback from doing business in China and other areas that are not viewed as politically friendly or politically correct, or taking advantage of people, or on the wrong end of the ESG and impact side. That's pushing companies to bring businesses back as well. So here's some of the factors driving it. I mentioned government incentives being one. I think what you're seeing is a lot of what the US has done is the same thing that China did, but now we're getting the Europeans very upset with this because it's really impacting Europe at a time that their manufacturing setup is vulnerable. And if you think about the European economy, so much of it was driven by the German manufacturing engine, which is really one of the hallmarks and the anchors of the European economy. And now that's becoming questioned as to their long-term success because of the energy problems, because of other issues that they're facing over in Europe. And you're starting to see businesses move away from there. The challenge is going to be skilled workforce availability and training. And Mark just mentioned what they're doing in Ohio to focus on that. But I think this is one of the big things that companies are going to start being much more proactive in providing better training. But you also see this disruption risk, and the political instability is a big driver for it. So I think these are the factors going to continue to drive foreign direct investment and reshoring back to the US. And it really is going to depend on our ability to take advantage of the opportunity while the window is open and really leverage the strengths that we have in the US. So where is it going? And it's obviously going to the essential products. That's what's driving this. So it's the areas we know, it's the chips, it's the EVs, it's space. These are the things that capital has to flow, and it's going to continue to drive capital flows. And you can see here the industries that are attracting the most jobs in 2022 versus 2019. And the bulk of them are in the top four. So let's take a look at them in a little more detail. And you can see it's really about EV batteries and charging stations and the electrical equipment and components. It's about semiconductor chips, solar panels, and robotics. It's about pharmaceuticals and hydrogen fuel and chemicals for batteries. It's about drones and also EVs and aerospace. And then you get into the medical equipment and the things that we need. This is the essential areas. You want to own the things that are going to be almost required investments for companies and for governments, because if you're on the right side of these trades, you don't have to worry about what's going on in the broader economy. And this is why I'm so positive about the opportunity to make money in this environment, is if you narrow your focus and don't worry about the market and think about the business going to benefit, you can really do well here. So where are the jobs coming from? Obviously, China's been on the wrong end of it from a reshoring. Mexico, a little bit more, and Canada. Those are all kind of from some of the slop we had over the last couple of years. Now we have a new agreement, so I think that's going to slow. Korea, obviously, is one, and India as well. On the foreign direct investment, it's Japan and Germany, where companies are looking to get closer to the US consumers. And also in the case of Germany, I think they're getting closer to more reliable sources of energy that they can have for a longer period of time. And the states that are attracting people are unusually New York. I'll throw out that was the two Hail Marys that they got. One was from Micron, and the other was from a EV battery maker called Iridium EE, I think is the name of the company, or 3.3. Anyway, that's what got there. But you see Ohio, where we are today, is one of the big beneficiaries. We talked about North Carolina, Georgia, and the South. What Ohio has, and Mark mentioned some of these benefits, is this is an old manufacturing area. The whole Midwest, upper Midwest has this. We're big in traditional manufacturing, so bring it back to areas that understand manufacturing is important, but the student base here is also important, and the government incentives are quite important as well. I think in the South, there's a number of things that get to right to work issues and other areas that are really attracting money, and they have been magnets for foreign direct investment for some time. So we've gotten very accustomed to those areas attracting a lot of capital. And the South and the Midwest will continue to be the big beneficiaries, I believe, for quite some time. We're moving back away from the coast as so much of the capital is concentrated there for the last several years. You're seeing that in so many presentations in the venture capital world. We see that in the public markets as well. We're getting back to the old economy being good again. So what's likely to slow reshoring and foreign direct investment? There are forces, and I think we're in one of those stages now where we've had a very good cyclical opportunity for this reindustrialization. But I think we're in part of the cycle where some of the issues we're facing around the country, worker shortages being one, and skilled labor. You are seeing increased manufacturing capabilities from other parts of Asia, not China, that can benefit from the supply chain setups that are over there and still provide low cost of labor. So if we're not really moving in robotics fast enough in the US, that's going to be a problem for us. We are, I think, 13th or 14th in the use of robotics per worker for 100,000 workers, and we're way behind other countries in that area. That's a big opportunity for the US. If our interest rate and inflation differentials stay too high relative to other areas, that's going to be a problem. We are one of the few that we're still in the rate raising mode. We're, I believe, finished that for at least a reasonable period of time. I think the dollar strength, if it gets too strong, which we're not predicting, is one. And if there was a possible reduction of the 301 tariffs, which was really what it went after China, the 25% level, if we bring that back down, it'll make the Chinese cost of production much more attractive again. If we brought it back down even to 15%. So that'll be something to keep an eye on if what the Biden administration does there. So as we look at it, we're putting money in industrials and materials, defense, steel, copper, rare earths, and infrastructure plays, which have had a tough couple months. I don't care about the tough couple months. They're on sale now, and I think there's really attractive opportunities here. You can get steel companies like Cliffs and Commercial Metals, which are two essential commercial metals for rebar, which is essential for the chip manufacturing going on. They need twice as much rebar to build that because they can't have the vibrations. Those are selling for single-digit multiples 4 to 6 times right now. And you can buy the whole steel industry, the top 5 companies, for $75 billion. This is not an area that you should be avoiding here. Cloud and semiconductor is still going to be at work, and we think the security area is going to make it a much bigger competition. We like the balance sheets on these companies. They're not overly indebted, and we think there's real opportunities there in the continued energy transition. And I think healthcare is getting much more interesting. And with the advances in AI, I think that's one of the most positive areas you're going to see our ability to really solve problems. And I think from an investment perspective, you want to invest in the essential areas and problem-solving areas where zero interest rates, you can invest in anything because it all is going up. We're not in that mode anymore. So we're going to be, whether you're in the venture area, the private equity, private credit, or public markets, you're going to be much more discerning about solving problems with essential businesses that can get away from the vagaries of the short-term issues and some of the headwinds we're going to face from lower credit issues or access to credit being much more difficult. So we're going to stop there and have time for some questions.
So questions, comments?
How come California is underperforming New York in this? Larger state, more people, high quality education. That was pretty shocking, that one chart.
California got a lot of new companies coming, but they were minnows, not whales. So they are attracting business, but I think the incentives from other states are much higher, Duncan. If you think about what you can do to get it, what they'll do for you in Ohio, or what you'll do for you in the Carolinas, or what they'll do for you in Arizona is a lot different what they can do for you in California just because their budgets. So I think budgets are a big part of it. And also the public has to be supportive of it. And when the governments give incentives for people that aren't supported, it blows up the opportunity. And the states like Ohio and others are welcoming the business coming back because they lost it once before and they know what it's like to lose it. So I think those are all the factors that are at play there. And I think people have to move money out of the coast back to the rest of the states because of concentration risk, which we found out how that plays out with some of the banking issues we went through recently.
So just like one follow-up, the New York, we always think of New York City, but actually big part of New York is probably a lot more like Ohio. Is that where some of this is going?
That's going upstate. Areas like Rochester, which were manufacturing areas in the past, are attracting businesses back. And they're also, again, close to some nice universities there too, with some access to talent as well.
Other comments, questions?
Hey, Stephen, 2 points. It's Peter. For California, I don't know if anybody got the chance to see 60 Minutes this past weekend, but they call it an area, I think 40 or 50 miles east of San Diego, Lithium Valley, where they expect that area to provide, I think, the bulk of lithium needs, at least for the United States and then around the world. So anybody in that area, there's going to be significant work and opportunities, and I know there's a lot of excitement. So that's first point. Second point, just from a geopolitical standpoint, have some clients doing business in Turkey, and you may know that there's an election coming up on May 14th, and surprisingly, I learned Erdogan is expected to lose. So there's a lot of going on now. There's a lot of things going on already questioning the election and so on. So a lot of protest, and my friend had to go over there to secure some business things he's doing. So I don't know if you're aware of that, but Turkey is an interesting place because it plays a significant. It's a NATO member and it plays a significant role in the world. So
Yeah.
And interesting, Peter, one of the deciding factors on that election in Turkey could be the Kurdish vote.
yeah,
Which is not a supporter of the Kurds, and they could be the ones that swing the vote against him, and have, I think, a reasonable number of seats in the government going forward, which would be a very different Turkey.
Yeah. Fascinating. I didn't know that. Yeah, that's great. Did anybody else see that 60 Minute special on?
I did, but I saw like bits and pieces, Peter, and I have questions about that. Like why it's like a sort of a re-injection, but a processing pre-re-injection. Do you remember what the core technology?
Well, it's going to be the supplier of lithium. So that the whole idea of what we're doing with DARPA and what you see in Intel in Ohio there is doing things United States, or so we don't have to rely on the supply chain issues, not only from China but from around the world. So to the extent we could natural.
The implications are massive. But do you remember why San Diego? What I wasn't focusing on it.
Because if you look at it, it looks like an area out, like it's on Mars, but that is where the source is, and it literally is bubbling up from underground. So it's Lithium Valley because that's what the material is.
Yeah,
It'd be interesting to see the challenges of that state engaging as a massive producer of lithium because of the extraction price in the process and the amount of energy and water you need to do a lot of the mining for these things is goes against a lot of what the state prefers to do.
The dichotomy, you're doing all this for a clean energy environment, but to get that lithium out of the ground, there's huge industrial challenges to do it. But they're literally setting up the facilities right on that land. So that's where it is. So just something to watch, and you'll see a lot more people going to that area. A lot of money too.
It'd be interesting to see the sources of energy they use for it too, whether it's going to be with the renewables or there's more talk about using small nuclear reactors to.
Warren Buffett, I think, already has a place that's activated there, and they're just expecting a lot more power plant-like facilities.
So speaking of Warren Buffett, Wanda, you've just come back from Berkshire Hathaway. Can you give us some takeaways?
Yes, I have. So 43,000 people in the arena, which is yet another record. The meeting, the annual shareholder meeting was very interesting, but this whole event is like a festival for the shareholders. Shareholders this past year were very happy, including myself. But the whole meeting was focused on few themes, which is Berkshire after Buffett and Charlie Munger. Remember, Charlie is 99 years young, and sharp as a razor, though he was wheeled into the podium and in the wheelchair. But Charlie was the same Charlie as at the previous event. And Warren Buffett, that's my personal take. You could see the effect of aging, not that he's any less brilliant in his analysis. I hope as a shareholder he is not. But in terms of the level of energy and approach to different things. So Sunday, I also participated in the Markel.
Well, I'm on a conference call at the moment on the other line.
Okay.
I participated in the Markel annual shareholders meeting, which is to me like, financial institution, but to some extent, a small version of Berkshire in terms of a business model. And I could see the difference in the energy and, for example, in the approach to AI. So the younger shareholders asked Buffett many, many times from different angles about AI. His response was standard. I don't understand. Bill, meaning Bill Gates, was trying to show it to me. And I am trying to understand how AI can destroy us. But he played down this whole area. On the other hand, Tom, whatever his name is, the CEO of Markel, chair of the board, had a very interesting statement saying, we cannot comment on AI because we do not fully understand the effects. But number two, it's real, it's there. And number three, we are using it. So very different approach to this area. Climate change came up from different angles, number of times against the resolutions from institutional investors that did not pass, mainly because the bulk of the voting shares are in the hands of Buffett and his tribe followers, but it's been more and more pronounced. I'm personally looking into when Greg Abel and Ajit will take responsibilities for daily operations and capital allocation. Greg Abel is in charge of Berkshire Energy, and he's championing renewables. So there is that investment into renewables. Buffett has his views on the lack of country will to move into energy transition. They are trying to deal with the utilities across the state line, and Buffett compared that battle to the World War II, where the states and companies were pretty much told what to do. There is no political will to build a cohesive energy transition strategy. And one question that I have for Stephen actually is, so I'm a big proponent of transition in terms of electrification of the transport system, EVs and charging stations and so on, and all the battery space. Buffett, on the other hand, Buffett and Charlie, I don't know who more, they see the future of transport in trains. So they invested a lot into this BSNF. They are experiencing their challenges. I personally think, again, I'm not comparing myself with Charlie or Buffett, but I think they underestimated the cost and importance of the train infrastructure that in the US was pretty much laid out in 18th century, and to move it to the smart trains and smart the autonomous trains in 20, 30 years, it will take tremendous investment, I think. So I'm seeing the future of electrification more in autonomous fleets rather than autonomous trains. I think the Chinese case might be different, but mainly because China spent the last 20 years in investing in fast trains and new infrastructure. So being a shareholder of Berkshire, they put their chips on trains. I see the future in electric vehicles. Stephen, what's your take on transportation in 20, 30 years?
There's not going to be, you can't buy many railroads like Buffett did. So much of what moves on the rails, it's different, there are different levels of transport. So I think what we move on the rails will probably move on the rails for some time. I think other transportation will come faster. I do think one of the things about electric vehicles that I was reading in the last week is that the cars are depreciating at a much faster rate. So your value 2 years after you buy an EV is much lower than what it would be on a traditional car. And if you think about it, it makes sense because technology after 2 years is all new anyway. So is that going to slow down if people lose the value of their cars at a much faster rate? Is that going to slow down the transition as well? So I think there's a lot of questions still that are going to make the transition a little bit more lengthy than people would like. Mainly the lack of a plan is the one, but I think you'll find out that the costs and the issues are much more difficult than people want from a ideological perspective. When you get into the practical nature of it, I think it's going to take longer and be more expensive. So I think the traditional systems of energy and the traditional systems of transportation will be around for a little bit longer than people would expect.
Buffett sold his small in BYD already this morning.
Stephen, as a new owner of a Ford Mustang Mach-E all electric, I think that it's absolutely remarkable the way the system works. That's why you want to lease it today. Exactly the reason I use, because it's going to be changing so rapidly. But I'll tell you, I drive to Rhode Island once a week, and 90% of the time I've got my hands in my lap, just relaxed, listening to a book and letting the car do the driving. It's incredible. And as a reference point to that, my son is the Ferrari sales manager at Miller Motor Cars in Greenwich, Connecticut. So we don't quite see eye to eye yet.
I think the other issue with transportation is just kind of pedestrians, cyclists, city infrastructure. We've got this huge, highway infrastructure, but we also have to take into account quality of life and the choice that we've taken for SUVs and trucks and all of this. The amount of pedestrians dying in the US is at an all-time high. And your chance of dying in the US opposed to other developing countries is much, much higher here. But that's not what I wanted to ask you about. Stephen, I'm wondering about Mexico as kind of this reshoring location and this transitional space for Chinese companies and other companies that are looking for access to the US market. What role are we going to continue to play? I think of Turkey as kind of a gateway maybe to the Middle East from Europe, and Mexico as a gateway to the rest of the world for companies that are looking to get into the US market. How does that play into this whole discussion?
Well, Mexico and Canada are going to be beneficiaries because they can do things that we can't here. So some companies will take advantage of those two locations for friendshoring, they call it, moving it close, but not necessarily into the US. I think Mexico is in an interesting position right now because their president just came out pretty strongly against China trying to circumvent things in their country and is pushing back on whether China's usurping some of the sanction rules and violating some of Mexico's rules. China said they weren't in Mexico, so they had evidence of it. I think it's going to be interesting to see how that plays out. I think Mexico has a whole bunch of other social issues that they're dealing with now as well. So I think Mexico is a place that people will go. I think it's going to get the benefit of the proximity to the U.S. market. And I think you can play both sides against the middle there because it's a country that's has a lot of stress with the gangs and what like right now. So I think it's a place that'll attract capital, but it wouldn't be the first place I'd go if I had a choice.
Hey, Steve, it's Rob. Can you hear me okay?
Yes, Rob, how are you?
Good, thanks. Just a quick thought on the EV side. At the Milk and Lunch I went to in LA with BlackRock, they had one of their portfolio companies basically lead the lunch. Really unglamorous CEO, but it showed the importance of their commitment to ESG in the space. But my question to you is, with ride sharing, do you all as a firm have any idea, or do you track the metrics of Uber and Lyft as to whether folks click the green, basically the green option of having it picked up by an EV or a hybrid vehicle?
Yeah.
Or maybe someone,
Hey, Stephen, there's actually a company in Ohio, it's on one of our panels. Its whole model's about ride sharing as a corporate benefit. And they're rolling out throughout Ohio.
Yeah.
Carry on.
I don't have a good answer on that one. We don't track it. We're not invested in them. So we're not.
Mark, maybe you have some input on that area, or we could save that for that company another time.